Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1157A, and today's date is December 20th, 2016, and the title of the episode is U.S. Government Used Retail Estimates for the Holiday Season. The Economy is Tanking. Now, before I get started, I just want to make an announcement. Today, I put up an interview with Harley Schlanger on the X22 Report Spotlight YouTube channel. And all you need to do is go to YouTube, type in X22 Report Spotlight. It should bring you right to the YouTube channel, and you can play the video there. Or you can come on over to the X22Report.com site, scroll down a little bit, it'll be on your right-hand side. Same thing with NewsSentinel.com. Go to the site, scroll down a little bit, look over to your right-hand side, and you will see the video there, and you can play it right on the site. Let's get into the economic collapse financial news. Now, we've been reporting on the economy for quite a while, and we've been seeing many indicators that are coming true where we reported on them a month ago, 4 months ago, a year ago, and we're starting to see some of this. Actually, what we're seeing in the auto industry, things are rapidly deteriorating very quickly. We talked about channel stuffing in the past. We talked about how the auto industry calculates sales as they push cars into the dealerships. Those are counted as sales. And we know that Ford right now, well, they idled 4 plants. And we see GM and Fiat Chrysler, they announced today that they will idle 7 plants across Canada and the U.S. as they reduce to work near record inventories amid weakening sales. And what we're seeing right now is that inventories to sales ratio they're above historical peaks. This was only beaten by the huge spike in 2008 when sales completely stopped. Well, the pain for automakers, it has just begun, and it is going to get worse. We see GM's inventory of vehicles on dealer lots at the end of November stood at 874,000, up 26.5% from the same time a year ago. And right now, factories, they will close anywhere from 1 to 3 weeks. And this will put about 10,000 workers out of work right now. They'll be idled right now. And we'll have to see and watch how the auto industry does. Now, we've been talking about retail sales. And in past reports, we talked about how they use estimated retail sales, because if they don't have the numbers or if they don't like the way the numbers look, they estimate what the sales are going to be. And if a store goes bankrupt and they go out of business, they don't just drop the retail sales. They spread it over many months, up to a year, where they can phase it out so it looks better on paper. And right now, the Census Bureau reported that its advanced estimates of retail sales for November, well, they show a 0.1% gain, which we mentioned before. And this is a 0.1% gain from October and a 3.8% gain over November of 2015. Now, Wall Street forecast was about 0.4% gain. And that's not the problem. The problem is that the headline report of a 0.1% increase in retail sales for November, it's based on guesstimates by the Census Bureau for the largest retail sales categories. If you go through the data tables that accompany the headline retail sales report, you can see asterisks in the not adjusted data for November in most of the business categories. And we can see that these are advanced estimates, and they don't really have the sales, or the numbers were much lower than what they expected, so they brought them up. They do this quite a bit. Now, on an inflation-adjusted basis, the 0.1% gain reported for November is actually a decline. And that 0.8% gain reported for October, actually that was revised down to 0.6% gain. And it is highly probable that November's numbers, guess what, they'll probably be revised to negative when December's retail sales report hits in January. Now, we understand that they're going to manipulate these numbers. And what we'll be looking at is the numbers from the stores themselves, because it's much harder to manipulate those numbers. Now, according to a research piece published by Cohen and Company on December 14th, they are saying that mall traffic fell by 6.4% in November from October, and December month-to-date traffic was down by 9.9%. Even with the growth in online retail sales, e-commerce accounts for less than 10% of total retail sales. And the Census Bureau estimated e-commerce represented about 7.7% of total sales in the third quarter of 2016. Now, we know that everyone is out there and the corporate media is out there, and they're saying, well, the reason why traffic is slowing in the brick and mortar stores is because everyone has moved to online sales and those are really picking up. Actually, they're really not. Yes, people are moving from brick and mortar and going to online, but it's not like we have an additional inflow of people ordering online, spending a lot more money. We just have the same people that were shopping in the brick and mortar stores shopping online, but online sales hasn't really increased that much because the overall sales, they're down, and that is including online and brick and mortar. And again, these are guesstimates. So we're in trouble here. The economy does not look good whatsoever. And as we come out of this holiday season, we can see already that this is going to be a disaster. Now, of course, the corporate media, the U.S. government, they're going to try to spin this as much as they possibly can. They do this all the time to make you think this holiday season is doing really, really well. They'll throw out numbers like, "Ooh, online sales are doing $3 billion in sales," which are meaningless because if brick and mortar lost $3 billion and online gained $3 billion, what happened here? Nothing. They need the overall sales of what's happening in brick and mortar and online. And of course, they're not going to hand that out because it would show that things are much worse than they really are. We see Caterpillar. Well, they have posted a record 48 consecutive months of declining retail sales. The company has not reported a single monthly uptick in sales for 48 consecutive months. That's 4 straight years. Now, this period is 2.5 times longer than during the Great Recession, which was 19 months. So we're in this incredible recovery, and Caterpillar is showing a declining retail sales of 48 months. During the recession, the Great Recession, it was a 19-month drop. Is this really recovery? I don't think so. It's more like a disaster. But what's more interesting about this is that the stock continually moves higher and higher. So we have a disconnect here, or the stock market's manipulated. Now, when we look at the economy, we wonder, all these economists, these PhDs that the corporate media has on, they keep telling us how great everything is. So let's take a look and let's see how they're doing here with the economy. They talk about inflation. Conventional experts believe inflation has been near zero for the past decade and will continue to be near zero pretty much forever. Did they get it right? Well, people who are exposed to healthcare, guess what? They saw premiums skyrocket. People who are exposed to going to college, guess what? Tuition skyrocketed. Rental expenses have gone up. Housing has gone up. So are we seeing inflation? Yeah, on these real big ticket items, we are seeing inflation. Over the past, we've seen inflation on food, fresh food. So pretty much they're not correct, because those individuals who are paying for all of this, guess what? It's eating into their wallet or pocketbook. So far, they haven't been right about inflation. Productivity. The experts admit they are confused by the steep decline in productivity. And they're saying, well, don't worry, this is going to turn around once we get higher wages and profits start returning. But we don't see this happening. Productivity is declining. We see higher wages declining. We are seeing profits decline. It's not working. Wrong again. They said zero interest rate policy, ZIRP. The Federal Reserve, the EU, said that near zero interest rates were the fix-all solution to low growth in GDP, employment, wages, and business investment. Well, has this really worked out? What has ZIRP actually fixed? Nothing. What has ZIRP destroyed? Savers, pensions, the hundreds of billions of dollars in interest income that once flowed to savers, pension funds. And we can see right now, ZIRP is destroying more than it is helping the people. ZIRP is helping the central banks. ZIRP is helping keeping the economy propped up for their benefit, but it's not helping the people. Employment. We know that the corporate media, the U.S. government, they use statistical trickery, but they can't disguise one thing: the civilian labor force participation rate, because that continually declines. All they do is continually throw people off of it and say they're not just looking, so hey, we're not going to count them. But it shows us that it is not working whatsoever, and this is proof that whatever they're saying about employment being at 4.6%, it is completely untrue. And we can see right now, everything that they've been talking about is pretty much a lie, and they spin everything to make it seem like everything is working. Now, something very interesting with unemployment claims. In hard times, when layoffs are widespread and new jobs are scarce, this number spikes. In better times, when jobs are plentiful and employers are desperate to keep good people, the number falls. But when it falls past a certain point, wages start rising at a rate that leads, through market forces or Federal Reserve action, to rising inflation and higher interest rates, which are destabilizing and generally cause a recession. And when we look at this cycle of initial weekly unemployment claims, and we go back in time and we look at 2000, if we go further back, I should say, going back to 1974, we see that unemployment claims were at its lowest point. We had a recession. Fast forward to 2001, what do we see again? Unemployment claims drop, and we saw a recession. Move to 2008, unemployment claims drop once again, and we had a recession. Here, we have dropped below all those points, and we are now back to 1973 levels, which is quite low, which tells us that we are heading towards a recession. Actually, at this point, we are in the recession. We are heading into a depression. Now, we can see right now that out in India, the demonetization of removing the 1,000 and the 500 rupee, well, it is not working. We can see that India is rapidly plunging towards a police state, and they were doing all this because of crime, drugs, to get this currency off the streets. But we know the real reason was to move this towards a cashless society. This is a test case. And we can see right now it is not having the effect that they thought it was going to happen. And things are breaking down in India. There are individuals that are continually standing online trying to get cash, and they can't at this point, and it's becoming very, very difficult. And we have to understand that this is not an isolated incident. They want to do this in Europe. They want to do this here in the US. Actually, they want to do this around the world because they want to get rid of cash. So we can see right now we're moving towards this period where they're going to be putting all of these plans into motion. And they're going to do this slowly. Remember, the central bankers, they don't work very quickly at doing these things. They move at a very slow pace, making sure that people don't realize what's going on until the day it hits. And that day is coming very soon. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.